crude oil in focus this morning. Take a look. Analysts are projecting a supply glut in 2020. This despite an initial trade deal between the U.S. and China, as well as OPEC production cuts. Joining us right now is the Schork Report publisher, Stephen Schork. Good to see you, Stephen. Thanks very much for joining us. Do you agree with those out there that are looking for too much oil, a glut in supply? What's your take for 2020?
Yeah, absolutely, Maria. We already have, to a certain extent, a glut if you believe in the term structure or the forward curve of the market. So what we've seen over the last quarter is the price of oil priced out into the future for nearer term deliveries, so on the front end of the curve, is losing value to oil priced further out along the curve. Now, in commodity markets, when the nearby market falls relative to the outside market, that is your clearest telltale that either you have too much supply, you don't have enough demand, or you have a combination thereof. So yes, the market is well supplied with oil. Now, I am going to put a caveat out there, Maria. What we are about to see, it began last week, and we're going to see it for at least the 3, maybe next 4 or 5 weeks. You're going to see a material drawdown in crude oil supplies in Pad 3, which is the U.S. Gulf Coast. Think Mississippi, the coast of Alabama, Louisiana, Texas, so forth. The oil refinery epicenter of the United States. You're going to see a massive drawdown. Probably, we saw a drawdown in barrels of about 3 million barrels last week. The market got all excited about that. You'll probably see at least another 7 to maybe 10 more million barrels drawn down in this market area over the next month. This is very normal, so it's very careful that investors or traders pay attention to this, because you're going to see media headlines touting the fact that these inventories are falling, and it's going to be a very short-lived decline. So you will see prices, the market fall, but the barrels will come back in January, because this is all about an assessment that oil inventory owners are encouraged to purge their inventories at the end of the year, because they are taxed on the amount of oil they've got sitting in inventory. So of course they want to draw down that inventory to lower their tax bill. So let's not get fooled by any sort of drawdown in the oil supplies over the next month.
It's a great explanation. Go ahead, Ken.
Stephen, question is oil glut, and it seems to be coming from the U.S., and yet there's a story in the Wall Street Journal today speaking to banks beginning to tighten loans to developers. So I get it on the seasonality at the refining level, but in the E&P area, could there be the question that there's going to be a tightening because the global supply is coming from West Texas?
Yeah, absolutely, Ken. It's an excellent point. So what you're going to have, we have to go back, keep in mind, at the end of 2014, all through 2015, oil prices crashed from $100 a barrel all the way down to $30 a barrel. So what did Wall Street do? They extended the credit to the oil patch down another 5 years. So those 5 years are up. So between 2020 and 2022, you have $140 billion with a B debt that is coming due. Wall Street is no longer in the mood to extend that slack in the noose. They want to see the money. So you're going to see a major contraction in this industry over the next 2 years. And that does, to your point, you're seeing a pullback on CapEx. There are going to be a number of the lower lows in that patch that are not going to be able to meet these debt obligations. So you're going to see a lot of bloodletting over the next 2 years. It's going to be an extremely difficult 2 years now in the U.S. oil patch for here.
Steve, it's Mike Murphy. Do you ever see a point where U.S. equities, energy equities, are investable again, or have a rebound from this long downward slope they've been on? Or will the price of oil need to move a lot higher for that to happen?
I do. Like, for instance, I mean, we saw the sugar high on that the Aramco IPO, an IPO that was 10 years too late. So the industry does recognize this. I think the industry is signaling to us that we're down in this range. That is to say that oil $55 to $65 range is here to stay, and hence why oil companies now, your major Western oil companies, no longer even call themselves oil companies. They are energy companies. They are natural gas companies. They are power companies. BP, Shell, so forth. So yes, the equities where the companies that are on the forefront of making the transition of branding themselves away from oil towards the petrochemical industry, towards the power industry, those are the equities that you have to be focused on.
Quick take, Stephen, for 2020. What's your forecast for oil prices?
Right now, through the end of the year, our models are showing a 15% chance we'll finish this year WTI above $60 a barrel. And the first standard deviation of our model for 2020 has oil range bound in between, say, the mid to low 50s to the mid to low to mid 60s. Again, a very normalized trading range through 2020, assuming we remain out of recession.
All right, we will leave it there. Stephen, it's good to see you this morning. Thanks so much.
Thank you.
Merry
All right,
Christmas,
Merry Christmas.
Stephen. Thank you. Stephen Schork joining us there.